Thanks so much for tuning in, everyone. I appreciate the opportunity to be here today. Really these workshops, or I basically want to take a couple steps back. Last fall, Dan and I did a couple 12 pre-harvest marketing plan workshops. We sure would like to do more again this year. These are roughly 4-hour workshops, and we try to focus on 3 common marketing concepts. 1, pricing targets. How do we set those? Where do we set those? Incremental sales, decision dates, something that's going to force us into taking action. And our goal without all these workshops is to provide you information and hopefully the confidence to develop and implement your own pre-harvest marketing plans. We spend a lot of time looking at the last 15 years to give us a little bit of hindsight on what market potential is. I don't think anyone has ever seen a year like this. But again, I think that's been very, very helpful. We like to do the corn, soybean, and grain sorghum ones in December, Jan, and Feb. We like to do the wheat ones in August, September, October. So if you'd like to bring one of these a little bit closer to home and have a 4-hour workshop locally, get a hold of your county extension office. We sure love to be doing those with you all. I think it's a great time to start thinking about these things. So really quickly, I'm going to review our the corn plan that we've had. Basically, again, very, very simple, 6 increments. We were pretty aggressive. And for us in our marketing plan here, like a lot of folks, this market took off way faster than we thought it would. We wanted to sell a little bit early at, say, at that 550 area, so we sure did. But the market really took off. And kind of looking at that thing, it happened to us like this. We priced our first increment January 4th at 556. A second increment at 511. So this market, corn market especially, just kept taking off. Come March 4, we said, we got to slow this thing down a little bit, because that's one of the key tenets of any kind of marketing plan. You've got to be a little bit adaptable. And so if market conditions, right, if war breaks out someplace, if weather issues start really coming into play, you need to make some adjustments. We rolled our marketing plan forward. We moved our targets up. So we started looking not for about a 630, but we were looking for 672. Didn't take very long. March 23rd, we hit that. So now we had 3 increments already priced, and it was already March. We wanted to be pricing a lot of this in summer. So we rolled again, hit that one at 751. So now we've had 4 price increments priced. We're 2/3 priced with this plan that we started kind of roughing out last January. This is an average price of $6.44. It's $1.44 over our estimated cost of production. So we're pricing in at a profitable level. Have we incurred some margin calls? Yes, this plan definitely would have incurred some margin calls. At this point, we're about 78 cents on average underwater. Yet we are $1.44 over our cost of production. And I think that's very, very important. We're waiting now for July 15th. We finally, after the 2 roll-ups, we've kind of got this thing caught up to where we want to be. A couple more increments, July and August, and we're waiting for 790. I think when we talked, or at least when we advertised this workshop, we said, hey, let's take a look at the soybean side. We did a workshop this past January in Salmon. We looked at this chart here, and basically one of the things we see, again, this is that 15-year seasonal index. Typically, prices will peak there in July, but we also see a pretty good peak in June, kind of a secondary run up there in September. And so we kind of looked at that, and you think, okay, well, we kind of stretched this thing out, but we ought to be pricing, and we think there's some opportunities pre-harvest, right, in that June, July, August, September timeframe. Our marketing plan that we set up then, very, very similar. We ran through those 15 years. We put them all in order, right? And we said, okay, if we started January 1, and so that furthermost column there, that 1219 for 2012, that was the price, the first trading day of January in 2012. That year it got up to 1768. So we saw between then and pre-harvest, or when we were going to harvest, a $5.49 run. Typically 33% of the time, we're going to see $3 or more of a run up. 67% of the time, we're going to see prices go less than $2, but definitely positive, at least $1. So from that, we created a marketing plan for the soybeans. Again, we were kind of using K-State numbers. We had a cost of production estimate, roughly $9.25. So we said, let's price them at $13.50. Just get some on the board. And then we used 50-cent increments, trying to price a lot of that in that June, July, August, and September time period. Bottom line, we had increments in that plan, 5. We had price targets everywhere between $13.50 and $15.50, November futures. And then we had decision dates that if we didn't hit that price target, we'd go ahead and take action. Just like the corn, this market took off way faster than we ever would have anticipated. January 3rd, we were that first trading day, we were at 1284. So we priced our first increment January 28th at 1350. We priced our second increment at 1460 on February 7. At that point in time, we hit February 10. We said, let's roll these forward, just like we were doing in the corn. We hit another target at 1508 on March 23rd, rolled forward again on April 8th. Over that time, we wouldn't have made any more action, or we wouldn't have taken any more action. So at this point, this pre-harvest plan that we would have developed back in January has us priced at 60%. An average November soybean price of $14.25. It's $5 over our estimated cost of production. So again, I would say a very profitable plan. But again, we've hit some margin calls, very, very similar to what we saw on the corn side. But again, we're pricing at a profitable level, and I think that's the key thing. I want to go back and just kind of look at these charts, December corn and November soybeans. I'm not a big technician, but obviously beans have been trending up. But as you look going back, say from that October, December, January timeframe, the range of speed has slowed down. Although we are, that's a pretty wide channel. On the corn side, we've been moving more sideways here lately, right? We had a very, very strong run up. We were adjusting our marketing plan, and now we're finally kind of caught up to where we want to be. And I was visiting with some folks. I try to visit with people that I consider pretty bright. That's why I hang around a lot with Rich and Dan. But they were telling me, you look at that chart, the bottom one there, say, especially from that May 15 period, and you could almost make an argument that's a bit bearish. Looking at that a little closer, you look at that, really since about mid-May, we saw prices kind of fall. And if you look, I don't know, maybe it is a little bearish. I don't know. But I think that's what kind of gets us, brings me to this point. And that is one of the things Dan and I talk about all the time when we talk about marketing plans is keep it simple, right? We want to focus on what we can control. We want to keep our lenders informed, and we want to work with our broker and market consultant. There's a lot of things happening. And it's been very, very, crazy, but maybe, we saw that December corn futures kind of moving a bit more sideways. Just November beans moving a little bit slower. I think you see the same thing on the wheat. It was out of control there early. It's kind of slowed down, moving a bit more sideways. I think a little bit down even today. I have to go check. But I guess a point we started to bring up last month at this webinar was just remember, the longer this all goes, the more we're going to learn. And the more the world is going to adapt. We're going to figure out, they're figuring out how to get Ukraine grain out slowly. We don't know what's going to happen there next, right? But the U.S. corn and beans, we were very nervous about that. Are we going to get them planted? They're largely in. And really, I think the corn is not much farther behind, say, the 5-year average. Beans a little bit. North Dakota's got some issues. We're still kind of sorting out what the prevent plant will be, but largely the corn and bean crops are in. June 30th, we're going to have a much better idea on actual acreage. And, from then on, it's going to be weather and yields. Again, a lot of crazy things can happen, but we continue to learn more. We're going to continue to watch La Nina and its impacts on South America, especially, but also the high plains. This is the third year they're talking now of a third year of La Nina, which is nearly unprecedented. We've had those before. Very bad for South America and their wheat, or especially Argentina. Very good for Australia, bad for Kansas. So we're watching those. Is this going to pull back, and are we going to get help? We're going to plant wheat this fall in good shape, or are we not? What's going to happen with Ukraine? Bottom line, though, is this: at some point, prices are likely going to weaken. And I think the very important thing we all need to be thinking about is, are we beginning to outline our 2023 pre-harvest plans? Yes, we've got to continue to follow through with the 2022 plan, and then we're going to have a post-harvest plan, but we also need to start thinking about 2023. At these very, very high level of prices, we need to be thinking ahead, and I hope you are. 2023 July hard red winter wheat is trading around 11.20. December corn's at 6.50. November 2023 soybeans at 13.96. These are really high prices. Let's start getting a handle on what our cost of production is going to be, because we need to start maybe thinking about what these plans are going to look like. Last month, we kind of threw out a tentative wheat plan, right? Step one, determine the percent of anticipated crop bushels to include. Step two, estimate your cost of production. I was kind of using a 25% over the 2022 North Central Kansas budget, so that would put us around 840. And then outlining a pre-harvest plan. Kind of throw out there the idea of getting way aggressive and maybe actually selling some 2023 wheat this coming month, right? But we've got increments, we've got price targets, we've got decision dates. And I had one last month of June 15th. I don't know if that's a bad idea, but again, I think you need to think about, where do you stand? So as we listen to Dan today, as you listen to Dan next week on the radio, as you listen to other Outlook folks, as you make your own decisions, you need to kind of start putting this plan together, whether you follow this kind of a plan or not. Maybe, again, I'm being a bit aggressive, but I think we need to be thinking about these things. Want to share one quick thing on hemispheric exports. I think y'all have a good idea about this, but US, Russia, Ukraine, and EU, those four countries or four regions export about 50% of world corn. And so, typically when you think about corn, every 6 months, we've got exports coming. 43% of world exports from Argentina, Brazil, and South Africa. If you take a look at soybeans, the US is 37%, Argentina, Brazil, Paraguay, 57%. So not quite as good of a rotation. But again, every 6 months, we're getting a fresh new look at new fundamentals and new bushels out there and new competitiveness. Right now, corn exports, we're not as competitive. We're on the soybean market. We're basically the market, and that's why we're seeing very good soybean exports currently. Look at that wheat number, though. 71% of world exports come from northern hemispheric countries. We're harvesting right now. Over the next 30 days or so, we're going to have a pretty good handle on what world wheat supplies are and what exportable supplies are. Really, all we've got out there then is Argentina and Australia, representing roughly, on average, about 19% of exports. So we're going to have a lot more information, and we're going to have a lot more certainty about wheat here fairly soon, really. Now, again, we got to get back around what's planting conditions going to be like, but that's a lot of time to potentially see a little bit of weakness maybe on the wheat. It'll be interesting to see what Dan says and see what we see as we keep going down the road. One thing I always ask, I try to hang around smart people. The other day, I was visiting with a couple folks, and they asked me this. They said, take today's futures price, add and subtract $1. So, if we're at December 2022 corn futures, and they're $7.21 roughly today, add $1. Yeah, it's $8.21. Take away $1, $6.21. Ask yourself, which is more likely? Because that gives you a little bit of a background on, are you a little bullish or are you a little bearish? As you listen to Dan today, ask yourself, is 8.21 futures a little bit more likely, or is it 6.21? What's Dan saying? What's he saying the fundamentals are looking like? If we're more bullish, clearly then we want to have a less aggressive marketing plan, right? If we feel like, man, the 8.21, there's a good chance we're going to see that, let's take it slow, right? Let's not be as aggressive when we start creating this plan. What about December 2023 corn? It's trading right now at around 6.51. Add $1, take away $1, 751 versus 551? Which one's more likely? As you listen to people give you their outlook and you start coming around, are you more positive or are you more bearish? Are there more things out there that could give this market strength? Are there more things out there that would be negative to prices? July week 2023, trading right now at 11.15, incredibly high. What's more likely for 2023 week? 12.15, or could we see the same weekend down to 10.15? Which is more likely? Again, these are the things you kind of want to build as you start putting in and creating your 2023 marketing plans. I tell you, we had one question that I'm aware of. As you register for this thing, and thank you so much for everybody who did. But one of the questions that were asked on that registration was, who are we, the farmers, competing against when we're trying to zero in on a strategy to sell grain? Huge hedge funds? What is our best approach to maximize ROI? It doesn't appear fundamentals are at the top of the list for swinging grain prices. That's a lot of questions there. I would answer them this way. I think your best approach is to be proactive. That's why we're really stressing the concepts of creating a pre-harvest marketing plan to go along with your post-harvest marketing plan. It's not a replacement. It's to augment. It's to add to. It's another component to your overall marketing plan. What is your best? And I think that helps you maximize your return on investment. Clearly, it doesn't appear fundamentals at the top of the list of these swinging grain prices. I think that kind of gets back at a couple of slides ago. As we learn more information, I think the fundamentals are going to come into play, personally. Things have been crazy because of all the uncertainty in the market. We've had multiple, what many would argue are black swan events. We typically don't have that. So I think this is the market's way of managing this uncertainty. But again, as we go down the line, we're going to learn more, and we are going to adapt. High prices are going to ration supplies. So when we think about who are we competing against, your neighbor. That's always the answer. As a farm manager, you are competing against your neighbor. Who's getting the better yields? When that piece of ground down the road opens up, who's going to get that cash rent? Who's going to have the dollars and the equity to be able to buy that quarter that fits right in with everything you've got? They've been your major competitor for the last 5 years. They will be for the next 20 years. They've been your major competitor for the last 100 years. Your marketing needs to focus on managing your price risk and avoiding mistakes. That's it. I want to be able to try to price and make sure I'm above and I'm covering my cost of production. That is really, in my mind, the key thing. We're not really competing against the funds. We're competing with this or what we're trying to do with our marketing plan is to manage our price risk. I think Dan will probably take a shot at this question too. Hats off to the person who asked it. That was a great question. Thank you so much for your time. I'll turn this thing over to Dan. But remember, if you're interested in trying to bring one of these workshops, it's a 4-hour workshop. We'll talk a whole lot more in depth about these things. Talk to your county extension office, and we'd love to come to your neighborhood.
Mark, thank you. I think a lot of times when we get involved in grain market outlook, we're not looking at strategies and how they play out as you're seeking to do here. I was finishing up one thing. Would you tell me in a nutshell where we're at on our corn strategy again? That was the first one that you just talked about. I caught the soybean one. Where are we at on corn?
Sorry about that. Yeah, we are 2/3 priced at an average CME December corn price of $6.44, which is $1.44 over our estimated cost of production. Sitting back now and waiting for a $7.90 target to come up there. And again, we got a ways to go before we hit that, but that's kind of what our plan would say, or we're waiting for July 15th. So really, in a lot of ways, we kind of got this whole plan now timed back out where we wanted to be, where these last two increments are coming here in the July-August timeframe.
Well, and just to talk on that just a second, we're coming into the time frame, as we've discussed in those workshops in person with folks, where we'll have a lot of grain priced coming in. Well, we're still in the midst of pricing. We start to get really wary of our opportunities once we get into July and August. I mean, that's what the seasonal charts have been. As we've looked at those here of late in the last 5 years, they become even more front loaded. So I think what I hope to say here will have something to contribute to that assessment. And I do want to come back to that question, but there's one or two slides in particular I want to frame it within. So we'll come back and address that. I would say in terms of who we're competing against, I think we're competing against the fallback strategy where we sell grain when we have a cash flow need. We just sell cash because we've brought grain in, we've stored it, we hold it, and sometimes in certain years that's a pretty lucrative outcome. But in a lot of years, in the majority of years when we don't have a short crop, and we're looking at more normal, again, a more normal marketing year, those years tend to be kind of a herd action in terms of people waiting and selling. And what really kind of bails us out in a lot of those years that we store long enough to where we get through harvest, we get into the next spring when we have some seasonality, and then we're hoping that the gain that we'd see is enough to offset the storage costs. And that's why we don't see as much long-term commercial storage as we do on-farm storage. So to me, I think as an individual, you're competing against that fallback, cash flow driven cash sales model. And of course, the way a person manages that or not, that does come down to how a person's finances are, how they work out. Are you in better position to bid for rented land or land or new land, those types of things. Mark, does that make sense to you as a response to that question?
Oh yeah.
Okay, sounds good. Well, let's move on. Want to talk about gray market factor situations in 22 and 23. Of course, we got tight stocks, we got a number of geopolitical factors, and I think, especially when you look at the futures and what they're showing into the next year, I think we've got the risk and uncertainty of where the markets are going are a big factor that are making the prices that we have now out in the future are $2, $3, $4, $5 higher than they were when we had the same supply demand stocks to use ratios in the past. And really that you've got some supply curve issues happening, some demand curve issues in play, but I think fear and uncertainty about the future. Economists are kind of hesitant to talk about risk premiums, but I think there's a lot of risk premium in these markets going into the future. And something for us to watch is when do traders start to become less fearful? When does that risk premium start to go away? That's why we watch almost with bated breath the reports that come out of Ukraine about whether they're going to be successful or not in actually harvesting their crop, being able to get that out into international channels, et cetera, to help alleviate this tightness that's come upon the world because of that situation. So I think the fear and uncertainty and risk are big factors. In fact, normal economists, as Mark and I and Rich are, we said what factors would be affecting the supply curve right now? Well, higher costs. We've got a lot higher cost of production. That tends to shift the typical supply relationships back to the left. It costs more to produce something, so we don't produce as much. Tends to drive prices up a little bit, but that in itself is I think being outpaced by this big fear-driven jump of demand out into the future as people are fearful about what supplies might come. So you got some shift of the supply curve back to the left and a humongous jump in the demand curve out to the right. And if that jump has happened as we're hypothesizing here, then the thing to watch is what happens what would bring that back? Well, less fear, less worry about the future. And there's so many things now that we have in the news agriculturally that keep stoking the fires of fear that we're not seeing that happen yet very much. Let's go on. I think we'll have one or two slides that address that a little bit better. I do want to bring up the current weather situation. Out of DTN here, an article on June 1st. Another one came out on June the 7th last week, where we have a high pressure ridge coming in June, affecting that has the potential to bring hot, dry weather into the Corn Belt. Of course, this is June. If this was July, we'd be we would see risk being expressed in the futures again in a major way. But this thing is coming on. You have high pressure ridges building. I've seen good solid people, analysts talk about how much moisture is likely to be sapped out of the soil, et cetera. News release, an article just about 30 minutes ago came out and saying, well, for right now, the corn welcomes this, but you know what, if this continues on into July when we start tasseling and pollinating, well, that's a different story for corn. So right now it's fine, but we are going to use up moisture with this one way or the other, it seems like. And so we'll be watching to see what happens on the backside of this event here, last part of June. And again, July's not that far around the corner. If this persists, then it's something to watch. And Rich and Mark, if you remember Elwyn Taylor, we've had Elwyn come and speak at our Risk and Profit conference in the past, and Elwyn's a colorful character, but he did pound into us that the idea that in our most risky years, we're dealing with a La Nina weather situation. That's what we have, one that's persisted. And here we have a high pressure ridge setting up and forming. And let's hope, I honestly, for the sake of anybody growing these crops right now, that this thing doesn't come to fruition. But if it does hang around and cause problems with the production, then it's just one more factor to provide really strong support for prices and risk factor for the crops we're growing. And just to show you quickly, Drought Monitor, you can see in about the western half of Kansas, pretty severe drought, last one that's available. Southwest, parts of Northwest in particular. We'll see how the wheat crop comes through those areas as we come into harvest now. And to me, I'm for corn and soybeans in the broader Corn Belt, I note the predicted soil moisture situation. So we have dry conditions, hot, dry conditions coming in on top of the whole state of Iowa, good chunk of Illinois, southern Minnesota, Wisconsin involved in this, all of Nebraska, half of Kansas and the Texas Panhandle, all involved in all critical production areas for the U.S. crops, all dry. And oh yeah, by the way, we have about a week or so of extended period of hot, dry weather coming in. So this is something that won't lessen the volatility in the grain markets. It's just another way of looking at long-term projected drought areas. These, again, from long-term perspective, they're awfully dry, and here you've got this weather coming in. And some other wetter areas to their credit. And internationally, I don't think we need to hammer on this very much, but you do see the dryness in North America. You see the dryness that's affected South America. They're harvesting their second corn crop down there. The soybean crop's already been affected by this some. So I think we'll be watching to see what happens, as Mark had alluded to, with the La Nina effect in southern Brazil and other parts of that country. Pretty dry up in Europe, parts of Europe. France had reports of that, and France, Germany, major world wheat export suppliers, important area. Note between China and India, you do see those dry areas in India coming in now and affecting their wheat production. And of course, it was mentioned, you have the West versus the East in Australia. Let's take a look at corn and sorghum markets. As a source of volatility coming up, I think what we want to be wary of June 30th acreage report, USDA acreage report coming up. There's also a stocks report. Of course, that'll be important too, but we'll see if to what degree the planting problems up in the northern states may have well, the Dakotas, et cetera, may have affected corn acres. Right now, unless there's a major change, still looking at these numbers as the official call at from 93.4 to 89.5 million acres. So drop of about just under 4 million acres of corn planted, and we'll see where all that goes. Corn yields again, and this is where the dry conditions come in. Right now, the USDA is projecting a yield of 177 bushels an acre, equal to last year, equal to the record high. You know, I think we're all from Missouri on this. It's show me, you know, with the conditions that we'll be seeing, are we going to attain that? And you can see when we haven't, where we've gone. Just last 2019 and 20, 167 and a half, 171. Some years prior to that, heavens, we'd even be greatly concerned if we got down to 174.6 or, you know, something like that. So we have better hybrids now, of course, that's all to the good, but we're not bulletproof in terms of having dry weather affect U.S. corn crop. And I would say that so right now we're hanging our hat on something that in the last year we would have almost scoffed at. We're hoping for a 14.5 billion bushel corn crop. Our expectations last 1 or 2 years was 15. Well, because the acreage issue, we're down to we're down to 14.5 about, and here we're talking about what dry weather could do. So we have a lot of risk yet in the corn market, and just the possibility of the likelihood of strong support for grain prices going on for the next month or so till we get this resolved. And just wanted to show this in terms of the just the broader metrics of the corn market. Tightening stocks to use, strong prices. Stocks to use, note below 10%. Ending stocks, the USDA in their last report, June, actually raised those numbers about 45 million bushels for ending stocks, old crop and new crop. But especially the new crop numbers, it's pretty early to be hanging our hat on that quite yet. Note the price situation. Move this out of the way. Yeah, 670. So we have just about, it's a little bit lower stocks to use from 997 to 9.61 projected. And oh yeah, by the way, the price is about 80 cents higher. So some of this fear and uncertainty and risk having an impact on the market. Let's see here. I've found value in looking at taking this view and looking at what the here we go. There we go. What the current estimate of prices are, looking at the futures prices using a most recent basis data we had, projecting it out for the marketing year, using the weighted monthly averages, et cetera. You come up with a current number about 596. And that'd be for the current marketing year. For the next one, starting September 1, 640. Compare that to the USDA's projections. The current number is just dead on. But turns out that the futures are a little bit more pessimistic right now than the USDA is for where prices are going. Mark, this is where the comments that you've gotten that the wariness of bearishness could come into play. The futures are a little less optimistic about where prices are going than the USDA is. Any thoughts or comments on that?
No, I don't have any, really, to be honest with you.
Okay, just thought I'd, if you did, just go ahead and jump in. I do want to just look at a couple other things here. The corn market. Let's see, remember I do that. Right. Generally, we have been. You can build a case that if you can see my mouse, if you look at from the top to where we're at now, it's a downtrend. If you look at where we were at about in March, we're just thrashing around in an uptrend. So you know what? We're in June, and we have July and August and crop development and a whole bunch of other geopolitical things to work through. Yeah, I could see where it looks like we have some case for wariness in the market based on most recent trends, but the uncertainty hasn't been resolved. That's for sure. Did want to look at a little bit at grain basis, Garden City. Just note the strong uptick in most recent basis numbers in the red at the Garden City, Kansas. Way stronger than the 3-year average in the blue, and stronger than last year. They were tracking pretty close. So some hot, dry weather down there, concern on the part, it's a demand center. No doubt you're seeing strong basis, trying to grab any grain that's available locally. And oh yeah, they have strong enough basis, they'll pull in from a farther distance. Did want to also show what's happening in ethanol plants, with the support now in the, we'll be polite. This is about the only place where we can be positive, where I can be positive about higher gasoline prices, in that it does help to support the ethanol market. And the ethanol market helps to support the corn price. And noting Kansas again, we have the highest average basis of 60 over any state in the country, including anything in Iowa, Illinois, Indiana, and I think Missouri. Actually, Missouri is surprisingly strong too. So just where we're at. And you can see that in general, pretty good trends in terms of ethanol production, not being overwhelmed with stocks. So during the driving period, that's what we'd hope to see. And corn exports in general, you can see here, especially the that bottom line. Well, pardon me, that shipments have been a little bit bullish in the last week or so. Again, some of the dryness, I think, in South America coming into play, or uncertainty down there anyway. But then note where we have 13 weeks left in this marketing year, a fourth of the way to go, and we have about 9.5% of the next marketing year's projection already bought. So you've got a pretty strong pace in this marketing year, and that worry, that fear about that next year starting to express itself with buyers even going farther out. And a pretty strong pace for exports. You can see we're almost on pace to meet the record, which is last year, and with a pretty strong trend. So we'll see where we go on that. Ending stocks, in general, ending stocks versus prices. We've been bouncing around 8.3 to 10 to 9.6% stocks to use in the U.S. Prices have been moving to the higher side. So there's something more here than just declining stocks. And some of it's the international side of the equation. I did want to bring this to your attention. Try to put together scenarios of where we could go in the future. Again, and giving the USDA their due, thinking about just saying, okay, if 50% chance that what they're saying for next year, 2022-23 is right, and that's 675. Well, by the way, that's about 640, 639 futures, matching that to the futures, a little bit more pessimistic. So this is my own, the model between my ears, my own intuition, trying to think through it. Thinking, given what we're at right now, weather-wise, about 10% chance of going higher yields to 180, about a 20% chance of going lower yields to 175, and about a 20% chance of given these problems in the world, Ukraine situation not working itself through that well, and problems in South America, of strongly higher exports. So what you've got there is a couple of scenarios, about 40% chance, that's not 50%, it's about a 40% chance you're sitting right now of the fearful outcomes coming in. And that if you're a buyer of corn, something 790, 875 for corn. And we can say, well, how can we expect that? Well, we were sitting about a year ago wondering how we could expect to see markets we have right now. So in this theater, where we're at, market environment, it seems that it doesn't take much to put a couple of reasonable scenarios in there to see what happens to supply demand balance sheet, see where stocks to use take you, and they take you to 8.5, 7, 8.5% from where we're at now, 9.6, and you just follow where the markets would go normally, that would be pretty strong prices. And you can see that in general with this is that same information in chart form. And note that 675 is below the 2012-13 high of 689. But if we get either one of those scenarios happening, then we'd be going to the higher side. We'd be at record high prices. So it's a really critical 30, 45, 60 days that we're coming into in terms of the size of the U.S. crop and size of other crops and where the world goes. Did want to show you world corn supply demand. That in general, here we set ourselves in a 1 hour time frame, but there are such issues to consider. We are concerned about right now about the impact of Ukraine, Russia upon that conflict upon grain markets. But this issue of tightening stocks has been happening, well, for 1, 2, 3, 4, 5, 6 or 7 years, where usage has been just pretty strong in the world. Note that we've been on the production side tending to level off some, usage going pretty high, that even leveling off some, and stocks declining. So that's a recipe for prices to keep moving higher, to ration usage. It brings up the question: what do you have to have other than just tremendous crops for 3 or 4 years in a row to change that situation? So we're in a situation in agriculture that's probably, from our point of view, probably advantageous to us. We're growing crops that on the world stage are getting more and more scarce, and prices keep moving to the higher side. So thought provoking when you look at, so that's a world corn point of view. If you look at world less China, and note the USDA already has some adjustments. That looks to me like they're about 50% adjusted on their numbers for Ukraine. So world less China, Ukraine adjustments are already in there to a degree. But what's not in there is Ukraine not being in the market at all. They're about 50% adjusted already in terms of the USDA numbers. But note that you take China out of this, we've been operating on the razor's edge for a while already. So just interesting to see this in how this is playing out in the markets. Take a quick look at grain sorghum. Note that the pardon me here, that the current price 628 in the current marketing year, projected for next year 666, and if anything, the USDA is a little bit low on the current number and just dead on to what the futures are saying for grain sorghum on the for the next marketing year. Note, we tend to forget about grain sorghum, but grain sorghum has had a pretty good year, having a pretty good year quietly. This note need about a pace of about 5 million bushels a week to meet the USDA's projection. We had this last week recorded about 8.5, 8.6, and that the pace that they're on, if they keep moving at this same pace, they'll end up and have a record year. But it's been slow coming, slow building. But I guess congratulations to the sorghum people. They're building and building and building to what could end up to be a record high year for sorghum exports. And you can see the growing importance of sorghum. That the risk with sorghum again is if out there somewhere China and Taiwan get into a conflict, other nations get into it as well, and sorghum, with its reliance on China's purchasing, is at risk. That's the issue they've been dealing with the last 1 or 2 years. And just note that so these are, you've got price relationships behaving badly. It is one way to look at this, in that, generally we tend to associate lower prices, lower supplies or stocks to use with higher prices, and vice versa. But since about 2020, we've been turning to the high side, and so you've got and what's been happening during that time is geopolitical risks. Russia, Ukraine at risk, affecting market prices. We're in the 21-22 marketing year. We're anticipating that next one and don't know where it's going to go. And note, this is a US dollar adjusted. So this is a currency adjusted price. That 665 in the US equates to about 787 in the world market. That's how they see that 665. So it's a deal. And it just seems to me that we've got risk-driven shifts in demand driving prices on the high side. Yes, we've got higher costs. That's affecting this some, but higher costs by themselves would tend to bring us to the left, more so in terms of the price usage outcome. But we're shifting so far to the right. It's a demand driven by fear deal is at least my assessment of thinking about this right now. So what takes it down? Eventually, if we come into a situation where we're not fearful of these geopolitical risks that we have in front of us. That's what I would wonder. Wheat, we got a few. Yeah.
Quick question. So as we look at that, and we start thinking about then, obviously, as just to sum up there, kind of where you're heading, is it fair to say then that you feel like, there's really good chances for further explosive growth, really in corn prices? And so when we relate that back to, say, this pre-harvest plan that really is going to take us through July, August, and September, we'll be cutting here in say 90 to 120 days here in Kansas. Maybe our price targets is 790, which would be another 70 cents higher, and a second target up there about 830 aren't too bad as far as pre-harvest targets. But then definitely on the post-harvest side, if we can, people should be considering doing some storing of their corn, right?
And note, we put a 40% chance on that of getting 20% on both of those for in what I presented, but in our plan, we hold that out there as possibilities. So you get to this point in the year and someone says, well, there's still a 40% chance of getting higher to these areas, then that's not an easy thing to consider, but it's saying that there's still probably the likelihood of the value in holding to your plan. There's still a good possibility these things could come about. But you really have to see literally how the supply demand factors work out. Does that make sense? Yeah. Okay, let's hit wheat and soybeans real quick. Wheat, the big report for wheat comes at the end of September. We'll have some acreage numbers that could come out that affect things here in end of June. And I think we're watching to see how much spring wheat got planted and what we're anticipating for harvested acres. how much failed acres did they have, and where'd those acres go? So that'll be an issue in this June 30th report that probably have some volatility in the market. But note that 78.2% harvested to planted acres, lowest since at least 2010. So tough stuff in terms of the U.S. number. And note again, we wonder, well, what's the long term of the wheat market? Well, I don't know, but our supplies have been moving downward pretty sideways to lower, especially you can argue from 2016, 17, but especially from 2019, 20. We're tightening up U.S. wheat supplies, and it's a thought-provoking trend. Not a surprise trend. You can see again, tighter stocks to use higher prices. Really same set of issues. Note the 1075 price this year 770, 505 last couple of years. So we're jumping year by year at about $2.50 a year. that's incredulous to consider the inflation that's going on there. And note again, in looking at the current prices, 779 in the futures for that next, well, that's for the old one. For the new one that we're into as of June 1, 1063 is what the futures are tending to say. And if anything, the futures are a little bit more, just a slightly more pessimistic than the USDA is. So not a lot to say there, but I also note that the futures, they're pretty, all these charts, they're all pretty flat. They really aren't showing any seasonality. They're putting all their efforts and all their, literally their trade, most of their trading volume into the first one or two contracts. Everything else just kind of marches in step after that. So thought-provoking to see what that means to me, that they're pretty reactive, reactive to anything that comes about. Here's how wheat looks on the chart. Generally, if you look at it from March 31st, you can say, well, we're in a trading range. If you look at it from February 21st, we're in an uptrend. So I'm not sure how quite to look at that, but again, short term, we've come down off the highs. We got up to about 1375, 1380, something like that. Went down to about 1110, 1115, now 1161. We haven't collapsed, fallen out of bed down below $10. We're still up in those areas. And again, Ukraine's ready to try to harvest their crop. And we read news releases today talking about how farmers are trying to figure out how they're going to harvest the crop in the midst of a war zone. Some more intense, parts of it more intense than others. Note that we, for Salina, wheat basis, so, if anything, running just a little bit weaker at these high futures prices than what we'd seen in, both 3-year average, 18 through 21 and 21 itself. We just came through a really weak year. That purple line, the lowest one on that chart, by the time we got to the end, is the marketing year we just finished up, 2020, 2021, 22. And I think the hope was, with all that's going on in the world, that we'd have gangbuster exports. But I think the high value of the dollar, high shipping costs, all working against U.S. wheat exports right now. And so there's wariness in terms of having wild optimism on that. So if wheat exports aren't driving us, then it's the world situation that's driving us to have high wheat prices. Note again, U.S. wheat ending stocks, and put this chart together as a way to get a perspective on what's going on. And again, our wheat enterprise is losing volume. It's losing dollar value. I don't know what that means, other than our non-competitiveness in these export markets is having an effect on us. You can see our food use pretty steady, exports generally declining, stocks as people respond to other opportunities available to them, stocks declining. So overall, we're losing quantity. We're losing dollar value in wheat production in the United States. But some talking like that, and you see prices, the stocks used generally declining, prices jumping to the higher side. Did want you to know on wheat that seems like did put together some scenarios. 1075 that the USDA is projecting for this coming year. Got scenarios, every one of them above that. So Mark, as I saw your plan there, and folks, I didn't send this plan ahead to Mark ahead of time, and he could draw it off it. But there was an independent operation. So your marketing plan for this coming year isn't far off of what these scenarios are. Now note, gave the USDA their due and said, well, we're into that marketing year, and with a 60% probability that, yeah, maybe they're right. But you've got not insignificant probabilities of tighter stocks at every other scenario, and things being higher. And you see that on this chart here. And it just would show you the wheat stocks to use. Again, a cutback, about 50% cutback in Ukraine's already in here. And note again, the last 3 years, this one projected included tighter stocks, usage generally decent, kind of a leveling of production. New crop stocks to use, 8-year low. Take China out of the equation, do the same math, and the wheat stocks at a 15-year low. So that, we hear a lot of hyperbole and venting about a world food crisis coming. I don't know that we should go talking like that. We have tight supplies and prices are high, trying to ration it. That's the mechanism. but without question, it'd be really good to have several good crops in a row to change the trend. Right now, we are tightening up in terms of world wheat stocks to use, and that's supporting prices. And note, I just wanted to show this up there for wheat. We're off the charts in terms of where prices are at relative to the tightness of world less China stocks to use and that. So we've got about 1 minute here, and I'm sorry, I've got talking too much. I will let's talk soybeans. Just in quick manner, soybean, what we're watching for to happen on the corn numbers, we're wondering conversely how that's going to affect soybean numbers. So this June 30th report, has potential to be a mover. In general, we haven't had planting problems in most of the corn belt, so maybe these numbers will be right on. But it's those northern areas where you could see some swings. Yields, dry in June doesn't necessarily hurt soybeans, but we'll see where this goes on in the future. Production, note higher acres, decent yields takes you to this situation here where we have record high production expected and near record total supplies. Tight situation. Note the USDA's come out, projected 1470 for next year's prices, stocks to use at 11%. And you look at that, what are the futures saying? The futures are coming in at, well, let's see here. There we go. They're current 1321, new crop 1428. So the futures are a little more hesitant than the USDA is, and you always kind of wonder about that. So what do the futures think they know that the USDA doesn't? They're probably anticipating a stronger response in South America for sure, than a recovery anyway. And note where the price trends, again, depends how you look at it, but generally since early May, we've been in an uptrend. Strong. Look at that last line. 21. We have 21% of next year's USDA projection bought ahead before we have a single week in the marketing year, and we're 101% of this year's projection at 75% of the way through. So hot buying for soybeans around the world. Decent exports for soybeans, middle pack to good. Note the growth in soybeans, reliance on soybean exports, and really no major story there other than it's been a growing enterprise over the years, last several years. Prices, again, we're hanging around 4.6 to 6.1%. Pretty consistently, and oh yeah, by the way, prices have jumped from 857 to 1080 to 1335, projected to almost 15. So we have some inflation going on, and projection looking at either lower exports, higher exports, low yields, and less exports. I know what the USDA is doing, or I have an idea. They're trying to come up with a decent number. But here you've got I've got a 35% likelihood of 16 to 16 and a half, just in terms of what could happen if exports move higher or yields move lower. So there's not much to be bearish about in these markets at this time. And, you know, again, world soybean stocks to use 9-year low in the current marketing year that we're in, expectations of a recovery next year. Current year, world less China, 15+ year low. I'd have to go back ahead of 2012-13 to go find a year that's lower. Then, you know, in terms of the one that we're in right now, it's there in the red. So lots depending on this 378 next year, and that's South America coming through in flying colors with production.
Dan?
Yeah.
We've got one question on there, and basically that I saw at least, and basically it says, hey, we've got some folks that are wanting some to get started on 23-24. So again, those 23 crop marketing plans, wheat, corn, milo, and talking about or asking about what can we do that would keep upside. Let's see here. Getting started using tools that keep upside open while protecting current levels. Wheat, corn, milo. You know, while you're thinking about that, you know, what is your thoughts about, you know, one thing that would do that would be, I guess, what we'd call a minimum price contract, but you're legging it on. And, you know, minimum price contract being a combination of a forward cash contract and buying a call option. The idea then maybe, the idea being though that we'd leg that on. So like maybe buy a 2023 call now with the idea that as we see prices go up higher, maybe I'm not ready to actually forward cash contract, but look at forward cash contracting later, but using that call to kind of take advantage of some of the upside.
And would they was the question pertaining to soybeans in particular, or was it
actually the listed commodities are wheat, corn, and milo.
Wheat, corn? Okay. Well, you know, we could generally those type of open-ended transactions would involve options of some type. And frankly, what market put together, what we try to support is a proactive plan of anticipating price levels to, in a way, we're thinking in terms of future options, in a way. Ideally, the pros of using a put option are that you can. I think if you're looking at 2023, you're probably buying a put. You don't have anything planted. You're uncertain yet about your fertilizer, seed, etc. The safest thing to do to walk away from would be to buy a put. You put X amount of money down. A lot of times we're looking at that though more in January, February, March of 2023 than right now. This would be, I'm not even sure what's available this far out. So, and they're in this volatility, they're pricey right now. You come back to the issue: do you forward contract that far out, or do you hedge? It's always, and I guess I'm stumbling around to say that there are some risks to going that far out. We ran into some questions from Central Kansas in the last 1 or 2 weeks about people that had hedged wheat early on and carried it through, and then lenders to elevators, whatever, starting to wonder about carrying that position. So that combined with not anticipating a poor harvest, they'd forward priced ahead a year or so, but then the production uncertainty and really the institutional risk of the financing that the elevator's facing are both things that we can't just be Pollyannish on. You know, they're both out there. So you asked me a straightforward question, and I stomp around on it, but and try to avoid it. But so if you take the simplest answer, if you come back and you anticipate something which looks profitable for a proportion of your production, you can go ahead and price it. But it was easier to say that 5 years ago when we didn't have the same type of cost inflation that we have right now. Right now, we might see $12 wheat price. Is $12 a good price given the inflation that we may have on the cost of production side? So I'm sorry not to come through with a lot more surety, but what makes it problematic is the inflation on the cost side. We don't know what we're going to be running into. Does that make sense, right? As an answer?
Absolutely. And just touch base, I threw out there that whole thing. And again, the difficulty here is, what is everybody comfortable using? What kind of multiple calls you're using? Are you buying and selling? So, I really don't want to give a whole lot of advice over a webinar. But somebody said, hey, this legging in a minimum price contract, especially if you do it backward, buying the call first, isn't that speculative? The answer is yes, right? Buying a call without having that covered would be. I'm with you, though, that, God, I'd be really nervous about trying to lock in a forward cash contract, but that might be the combination. I think there's some other comments on there. In some ways, the easiest thing to do for folks, in my mind, on 2023 is just start assessing on where you want to set those price targets. And again, if our belief is that we do think there's way more upside, we don't want to be real aggressive on what those are. Let those be higher. Let's see if we see that big, high, crazy. Let's see if we see that 10% shot that Dan thinks could happen if something happens in Ukraine or something happens over here and we see that 70, 80, 90 cent pop, then maybe take more action. But at this point, maybe not. I think there's some other comments in there.
As you talk about,
yeah, go ahead.
As you talk about legging that on, I yes, you could. It's it can be speculative but there's so you'd want to talk with your lender and make sure people that need to know, your family knows what you're doing. But at least if you buy those calls, they're out of the money now. You're there's some rational reasoning that could justify you being in that position. And that to me, if you have a call position that you bought sitting out there, and it's out of the money, not worth much now, given all that's happening here, what if more conflict comes up in Southeast Asia? I mean, that can happen. And so something like that comes about, we start to move to the higher side. At least when you get up to those areas, you have something in place. You're not so paralyzed by the uncertainty of the top side still waiting for you that could happen. So I think there's some rational reasoning that would help to justify that, but you'd want to make sure that your lenders and other folks know what you're doing.
That'd be the one-sided. What about if a person said, hey, I'm going to go and make the sale with, say, H2A, right? HTA, hedge to arrive, and then using that call to retain your side. Kind of depends on the levels. I guess I'd like to see, and I see you've got some in there, but yeah, are you seeing the comments there?
Oh yeah, okay, makes it.
The H2A, so that way it's on both ends.
Yeah, I think if at least as I read that on the fly here, I think I was thinking my reason. Well, I was hoping my reason to be consistent with what's stated in that comment, and that making sale or HTA using call to retain upside against that sale. In general, that's the idea I would wonder about. And don't our biggest risk isn't in agriculture, it's in the financial markets. If the financial markets have a major crisis, then the commodities reflect it. So we're worried about the upside. It behooves us to be a little wary about the downside. It's not because the crops might, we could lose a lot of money on the futures and nothing happen in terms of anything supply demand wise for the crops. So we have enough financial risk, especially coming into an election season, that it just behooves us all to be wary of both the topside opportunities, but downside risks that could come.
Yeah, there's a lot of great comments in there, and these are exactly the kind of things I see from Phillips, Brady, Brian. These are exactly the things that we'd like to be able to sit down and run through in our workshops. So I guess, my 2 cents on this is all the comments that we're getting today on this webinar, to me, is just that much more fuel to say, contact your county extension office and let's have a workshop where we can kind of run the numbers on some of these kind of things. I think there's some great idea. Phyllis there's got I see here, outright put or a synthetic put. Yeah, those are the kind of things that we like to run the numbers on in our workshops.
I would say that we're planning to go through July and August for these monthly webinars to following up on this marketing plan, pre-harvest plan. Then we figure everybody will be harvesting. They won't have any time to come and listen to us. So, but then we'll have another set of workshops, and I think we're aiming for January, February of next year is my understanding, Mark. We'll have to look at the calendar.